Let me ask you something honestly. When was the last time you heard someone say, "This time it's different," and truly meant it? Because that sentence shows up right before every financial collapse in history. Every single one. Not after, not during, right before. The strange thing is, financial collapses never begin with panic. They begin with confidence. They begin when everyone feels safe, comfortable, certain. Think about it. Nobody wakes up one morning and decides, "Today the system will break." Instead, people wake up feeling optimistic. Markets are going up. Jobs are plentiful. Credit is easy. The news sounds reassuring. Experts sound confident. And anyone who raises concerns is brushed off as negative, outdated, or afraid of progress. This pattern repeats so consistently that once you see it, you can't unsee it. Every collapse starts with a story that explains why risk no longer matters. Sometimes the story is about technology. Things are different now because innovation has changed everything. Sometimes it's about policy. Governments won't allow another crash. Sometimes it's about math. Models are more advanced now. We understand risk better. But underneath every story is the same quiet belief. We've finally outgrown financial cycles. That belief is the seed. Because the moment people stop respecting risk, they start borrowing more. When borrowing increases, leverage increases. When leverage increases, small problems become catastrophic. And here's the part most people miss. Financial collapses are not caused by bad people or sudden disasters. They are caused by normal people behaving normally inside a system that quietly rewards short-term comfort over long-term stability. Banks don't suddenly wake up greedy. Investors don't suddenly become reckless. Consumers don't suddenly become irresponsible. Each group simply responds to incentives that slowly shift over time. Low interest rates make borrowing feel harmless. Rising asset prices make debt feel smart. Easy money creates the illusion of safety. At first, everything seems reasonable. A little more borrowing, a little more leverage, a little more risk. And because nothing breaks immediately, confidence grows. This is where the cycle becomes dangerous. When prices rise for long enough, people stop asking why they're rising. They start assuming they'll continue rising simply because they always have. That's when memory fades. People forget that markets fall. They forget that recessions happen. They forget that debt has consequences. Or worse, they acknowledge these things intellectually, but emotionally they stop believing them. And emotions drive decisions far more than logic ever will. You can see this clearly if you look back at past collapses. The names change, the instruments change, the technology changes, but the behavior doesn't. There's always a moment when caution feels foolish, when patience feels like missing out, when staying conservative feels like self-sabotage. That's when participation explodes. More people enter the market not because they understand it, but because they're afraid of being left behind. And once fear of missing out replaces fear of loss, the system becomes fragile. Not fragile in a way you can see. Fragile in a way that looks strong, right up until it isn't. Because systems don't collapse when everyone is scared. They collapse when everyone is confident. This is the part that feels uncomfortable to accept. The most dangerous moment in finance is not when headlines are negative. It's when everything feels calm, predictable, and under control. That's when debt quietly piles up in places no one is watching. That's when small assumptions become massive exposures. That's when stability becomes dependent on everything going perfectly, and nothing ever does. Here's how the shift happens, and it's so subtle that most people don't notice it until it's already locked in. It starts with stability. A few good years. Low unemployment. Rising asset prices. Steady growth. During this phase, people become comfortable planning their future around assumptions instead of uncertainty. Jobs feel secure. Incomes feel reliable. Returns feel predictable. And predictability is dangerous because it changes behavior. Businesses start expanding faster. Households start taking on more debt. Investors begin stretching for higher returns. Not because they're reckless, but because the environment quietly encourages it. When interest rates are low, debt feels cheap. When prices are rising, leverage feels efficient. When nothing has gone wrong for a long time, risk feels exaggerated. So the system adjusts. Banks loosen standards just a little. Lenders innovate just a little. Products become more complex, not because complexity is needed, but because it allows more growth. And growth becomes the goal. At this point, no single decision seems dangerous. Each step makes sense on its own. That's why collapses don't feel like collapses while they're forming. They feel like progress. Here's the critical mistake most people make. They assume fragility comes from weakness. In reality, fragility comes from over-optimization. Systems are pushed to perform at maximum efficiency, with no margin for error. Companies reduce cash buffers. Households live closer to their income limits. Governments operate with higher debt loads. Everything works beautifully, as long as conditions remain perfect. But perfection is fragile. All it takes is one unexpected shock, a rate increase, a slowdown, a supply disruption, a loss of confidence, and suddenly the assumptions that held everything together begin to crack. Debt that was manageable becomes heavy. Cash flows that were stable become tight. Assets that were liquid become hard to sell. And here's the key point. The shock doesn't cause the collapse. It reveals it. The system was already unstable. The shock simply exposes the pressure that had been building underneath. This is why people are always surprised by financial crises. They look for a single cause, one event, one decision, one villain. But collapses are not events. They're processes. Long, slow processes that move quietly while everyone is focused on the surface. Think about how people talk during these periods. You're overthinking it. The system is stronger now. Regulations are better. They won't let it fail. Those statements aren't irrational. They're comforting. And comfort is powerful. It allows people to ignore warning signs that would otherwise feel obvious. Rising debt ratios, declining productivity, speculative behavior disguised as investment, short-term gains prioritized over long-term resilience. None of these are hidden. They're visible to anyone who wants to see them. But seeing them requires emotional distance. And emotional distance is rare when money is involved. Because money isn't just numbers. It's security, identity, status, future plans. So when the system begins to wobble, people don't react logically. They react defensively. They double down. They rationalize. They assume recovery is inevitable because it always has been before, until it isn't. The most misunderstood part of a financial collapse is the speed. People imagine a slow, visible decline, a gradual unraveling, plenty of time to react. That's almost never how it happens. What actually happens is this. Confidence erodes slowly, then disappears all at once. For years, the system absorbs stress quietly. Debt increases. Margins shrink. Buffers thin out. Nothing breaks because trust is still intact. But trust is not a physical thing. It's psychological. And once trust cracks, behavior changes instantly. Lenders pull back. Investors rush to sell. Consumers freeze spending. Liquidity, the lifeblood of the system, vanishes. Assets that looked valuable suddenly have no buyers. Prices gap down, not because value changed overnight, but because willingness disappeared. This is why collapses feel like overreactions in hindsight. They're not reactions to new information. They're reactions to old risks that were ignored. And here's the harsh truth. Once panic starts, it doesn't care about fundamentals. Good assets fall with bad ones. Strong companies suffer alongside weak ones. Rational analysis is replaced by survival behavior. People don't ask, is this worth holding? They ask, can I afford to be wrong? That shift is everything. Because systems built on leverage cannot survive uncertainty. They require confidence to function. And when confidence breaks, leverage becomes poison. This is why governments and central banks always step in during crises. Not to save markets, but to restore trust. Liquidity injections, guarantees, bailouts, they're not about fairness. They're about stopping panic from feeding on itself. Sometimes it works. Sometimes it only delays the inevitable. But regardless of the outcome, the pattern remains. Collapse follows complacency. Panic follows certainty. And recovery only begins after excess is cleared. The hardest lesson for individuals is this. By the time collapse is obvious, options are limited. That's why awareness matters before the cycle turns. Not to predict exact timing. Not to live in fear. But to avoid being trapped by assumptions. The goal isn't to avoid all risk. The goal is to avoid fragility. So where does all of this leave you? Not as someone trying to predict the next collapse. Not as someone waiting for disaster. But as someone who understands how systems behave and adjusts accordingly. The biggest mistake people make is thinking awareness means pessimism. It doesn't. Awareness means humility. It means recognizing that cycles exist whether we like them or not. That stability creates risk. That comfort can be misleading. It means building margin into your life. Financial margin. Emotional margin. Decision-making margin. Because the people who suffer most during collapses aren't the ones who took risks. They're the ones who had no room to absorb change. No savings buffer. No flexibility. No alternative options. When everything depends on conditions staying perfect, even a small disruption feels catastrophic. But when you expect imperfection, disruption becomes manageable. This is why financial resilience is less about returns and more about structure. How dependent are you on constant income? How sensitive are your plans to rising costs? How exposed are you to assumptions you've never consciously choose? These are uncomfortable questions, but they're powerful ones. And here's something encouraging. You don't need to outsmart the system to protect yourself from it. You just need to avoid copying its most fragile behaviors. Avoid excessive leverage. Avoid overconfidence. Avoid building a life that only works in ideal conditions. Because while financial collapses always start the same way, individual outcomes don't. Some people are devastated. Others are inconvenienced. A few are even prepared. The difference isn't intelligence or luck. It's awareness and structure. History doesn't repeat because people are stupid. It repeats because human behavior doesn't change. But your behavior can. And once you see the pattern, you're no longer surprised by it. You're calm when others are confident. Prepared when others are comfortable. Patient when others are rushing. That doesn't make you immune to cycles. It makes you resilient inside them. And resilience, not prediction, is the real advantage. If this perspective helped you see financial systems more clearly, take a moment to reflect on how much of your own life depends on assumptions you've never questioned. Because the cycle will turn again. It always does. The only question is whether you'll recognize the beginning before the ending arrives.